Hello everyone, I'm Ted Oakley, Managing Partner at Oxbow, and I want to invite you to watch what we're doing here on the third quarter call. I think you'll find some interesting comments about it. One of the things you're going to find is that when looking at what investors are really worried about today, you'll see the social spending bill that's on everybody's mind, taxes are on everybody's mind, inflation, and really this potential runaway Federal Reserve Board. So those are some things that we're looking at as well. But when you get into the economy, let's just start with that. What we're seeing, the economy is slowing down some. You'll see here just this is a consensus forecast, really, that comes off of Bloomberg. But if you look, even the Atlanta Federal Reserve forecast is almost 2 points less than this. And so we're seeing some weakness as it comes in. In addition, and we think this will have an impact eventually, is that China is slowing. China's real estate slowing, China's economy is slowing, their GDP is slowing. They're having some trouble internally, and they've really pulled in their horns, and people don't remember that they are a big safety valve for not only employment and production, but for people around the world. We're keeping our eye on that. The other thing that's happening is we're starting, as we mentioned in the opening slide, about inflation. And interesting enough, and we put in here, I remember this magazine cover that came out in Business Week. At that time, Bloomberg didn't own them, but it was Business Week, and it came out in August of '79, saying that basically the death of equities. 2 years later, the market started on the biggest bull market ever in 1982. It was about a 2-year span. April 19, same Business Week, now Bloomberg Business Week came out and said, is inflation dead? And here we are about a little over 2 years later, and all of a sudden we've got the highest inflation year we've had in a long time, 5%. So we're looking at things like that as we go forward. The other thing we're watching is all this talk about transitory inflation, it's going to go away and all that sort of thing. Well, I don't think anybody knows that, and certainly we don't know that. I think you have to guard against it by owning some things that get you there. But just look at this chart of durable goods, okay? And that would be when you go down and buy a washing machine or a big piece of equipment or something like that. It's not the grocery store. Durable goods all of a sudden, and go down and try to buy one, okay? Everything's very expensive. You can't buy them, you can't get them in, and that's where we are today. We're starting to see durable goods come into inflation concept. So what has this runaway Federal Reserve done? Now, if you go back to, for 125 years, when the Federal Reserve put $1 of borrowed money into the economy, okay, they were getting back approximately 62 cents on that dollar they would put in of GDP, of production. Today, that's down to about 25 cents. That means that for every dollar that they put in debt, they only get back about 25 cents. And our good friends Lacey Hunt and Van Hoysenden always do this chart, and it's a really good chart showing where we are. The other thing that happens is if you look, Jimmy Stack has always put this chart out. It's great about the difference between the consumer price index and the home prices. Okay, there was a big spread when they broke last time at about 35%. Now it's about 42%. Average home price today just came out last month, $390,000. So we're going to see where that happens. Here's another thing about the Federal Reserve that they've ruined. If you look at the gold or orange line here, okay, that's the Fed buying paper. That's the Fed putting money in the system, freeing up, lowering interest rates, buying everything that's out there. Notice how much that line correlates with the blue line, which is the stock market. But rest assured, when that orange line decides to go down, it's going to have an impact on the stock market. This is almost 100% correlated over the last 12 years. And we've said that all along. This is all Fed induced. It's all an artificial market. We're going to see where it's headed. Also, we're seeing the speculative fever just keep right on going. This year, you'll see, in addition to all the SPACs that are out there and the high-profile IPOs, the initial public offerings, they are not, they are not making that much money, but they're coming at these crazy prices that are coming out. We're still seeing that side. The other thing I want you to notice here, and this is for all the individuals out there, they're riding high right now. because their homes are really high priced and their stocks are really high priced. Notice just even from 2015 in a 5-year period where they doubled stock price and home price. And you'll notice this graph goes all the way back to 1950. But we're in a period now where those things are really, really expensive. And I'm not certain people realize the extent to how expensive they really are. The last thing I might mention in this sort of this area that I think it's complacency or speculative nature is that most of the stocks are owned by people over 55. If you go look at what's going on right now, you've got almost 3/4 of the stocks are owned by people over 55 years of age, and you even have over 65, just less than half. And so you have a lot of people that are older that own stocks. They bought into the program, believe me, they're there. It's hard to convince them that maybe they should think about something a little different going forward, but that's a risk of the market, we think. If you look at the bond market, I'm only show a couple of things here on the bond market, but I'll mention this to you. This is the U.S. Treasury bond yield curve a year ago and today. Or it was a couple of days ago. But what you're going to see here is that, yes, the Federal Reserve from that 1 to 2 years, they can keep those rates down. They can keep those low, and they can remain low because they keep on buying bonds. But the bond market is telling the Fed, and you'll see that with the red line here, that over the past 12 months, hey, we don't believe you. We think we are inflating, and they can't control that line from 10 years out. They control the short end, but they haven't been buying any long bonds. Not that they couldn't, but that would be drastic if they did. The last thing I want to mention to you, and we talked about this 9 months ago or so, and we had a piece entitled, "There is no 40, because Wall Street has had this mantra for the last 10 years about do the 60-40 portfolio, 60% stock, 40% bonds. The problem with the bonds now is there's no place to get that yield. We haven't bought a bond past 12 to 18 months maturity. We haven't bought anything past that in probably the last 15 months. It's just, there's nothing there to own. And you'll see what's happened to these major bond funds and the government funds in this year to date. If people will look at their bond funds right now, you're going to find that even with the interest, which is the right column, you're down for the year. So that means that that's a sea change of what we've seen before. If that continues and inflation stays up, people are so locked into bond funds, we feel like that's an area they need to really take a hard look at. On the stock side, this is a chart that will really get your attention. It comes from Jerry Grantham, but it's one of the things about it is that it shows, and the Russell 3000, by the way, takes in about 98% of all stocks, okay? And what they're showing is that over the last 12 months, you've had a situation where, and you could use 18 months for that matter too, but you've got almost 60% of stocks showing negative earnings. And what that means is that people are buying things that they don't care whether they make any money, whether the company makes money or not, which is not the way you want to look at a business. You certainly wouldn't look at a private business that way. The other thing I'm going to give you a couple of examples that will give you an idea about what goes on. The first one is a company called Affirm. It's a buy now, pay later company, all right? Came public, this year. Had a low of $50, you'll see here in May, trading at about $160 now. Lose money, they lose money, okay? So their market capitalization is $42 billion and their revenues are just under $1 billion, okay, or right at $1 billion. So if you think about that, it's 42 times revenue. You'll never get your money back. Second thing you'll see is Upstart, which is basically Upstart is one of those personal loans that you can do obviously digitally with the internet, etc. No recourse in most cases. Here's another one that's selling. It's gone from 50 to 367, selling at 300 times earnings. The market cap is $28 billion, and they don't even hardly do $1 billion in revenue. Again, 28 times revenue. So what we're seeing is those speculative juices flowing, but at the same time, if you look at the volatility of the market, this is how complacent everybody is. Markets are not moving around much. You know, that's normally not a sign you see before markets really move up. They just typically will give, and you'll see complacency's been going on now for the last 4 or 5 years. People get less and less and less worried about volatility, which is about the time they should look at it, for that matter. And so y'all know Warren Buffett, and Warren Buffett has an indicator called the Buffett Indicator. It takes the value of all the stocks outstanding in market value, and it compares it to the U.S. gross domestic product. So if you look at all the things we produce in the U.S., and so if you look at presently, that's 213% of GDP. Now that's just the stock market, okay? So that means that it's valuing the stock market more than all of the real estate and private business, exports, consumer, everything that's in GDP. And it's interesting because the average over the years is about 100%, maybe 120. Gives you another idea. Another thing to look at right now is leverage. Everything is leveraged. Everything we see, a lot of the funds are leveraged. A lot of the private funds are really leveraged. And you'll see this is just normal margin debt, okay? Not counting what we call off-balance sheet margin, where they take securities and they do margin them, but they go through a bank transaction. This is straight into the market. So we've got a tremendous amount of leverage against stocks, which will pose a problem in time. We've had a good year this year, I will tell you. On the conservative fixed income accounts, we're not negative. We're not positive by a lot either, but we're certainly above the numbers you saw earlier. Secondly, our high income accounts, which really are set up to try to beat the bond market, are probably 8% or 9% higher than what you saw on those bond funds. The third thing is our long-term growth accounts done well, and we stayed with the right kinds of companies. I've given you here just some of the companies we own, you know, in different things. You'll look at Brigham Minerals, for example, and Chevron we own in the high income accounts. They have great dividends, great cash flow. If you look in the growth accounts, you'll see Google, Alphabet, Microsoft, O'Reilly Automotive. We've had good years of those in the growth account that we manage. And then on the commodity side, Nutrien, which is fertilizer, it's had a good year as well. You can find things that do well in these markets, but you have to really search for them, because a lot of things are pricing out where the companies are not making money. All of these companies make money, by the way. And so that's where we are at this point in time. So if I just give you a summary of where we think you should be and things you should think about, okay? Number one, you need to keep those bond maturities short. I still see today people coming in and buy millions of dollars worth of bonds that are 15, 20, 25 years out that they're getting less than 2% on. So I'm thinking about this. I'm thinking, well, okay, if I own a bond that's at 1.5% for 20 years, what good is that going to do me? Which is nothing, if you can get right down to it. The other one is own the best stocks with cash, low debt, and visible growth, okay? Chance Finucane has done a great job. He's our Chief Investment Officer, of really owning companies that can grow. You know, they can grow through bad times as well. But those companies don't have a lot of debt. They have a lot of cash. They're growing at 15% a year or more. We feel like they can the next 5 years. In the high income area, we continue to search out companies that pay a lot of cash flow. And that can be in the form of a stock, it can be in the form of a preferred, it can be in the form of a pipeline, a number of things that come into play. But what we're looking for there are companies that pay higher cash flow than the norm. And the last thing, and you've heard this from us now for really the last year and a half or 15 months for sure, you got to have a cash buffer. When you have things this expensive, you can say, well, my cash is not doing me any good, but your cash is your insurance policy. And if we're dead wrong and everything else just keeps right on going, that's okay. You just didn't participate as much. You know, maybe you're participating with 75% instead of 25%. instead of 100, but you got 25 in cash. So I want you to keep that in mind. Most really, really large investors have cash. So you as a smaller investor, when I say that, under 50 million, it doesn't hurt you to have cash as well. Just keep that in mind as you go forward. So as we move forward, I'm going to tell you, I want to thank you for being here today, listening to what we're having to say, looking at what we're doing. We really have done well this year considering what's going on in the marketplace. We think we're in good position. We've got a great balance in the portfolio. But if you have some comments on that, I want to hear from you, please. But if you have anything you want to know more in detail about that, certainly either give us a call or come and see us at oxbowadvisors.com. And with that, I'll look to see you next quarter. Thanks.